People need an income that's guaranteed to them.
If you lose money to taxes, you're never getting that money back.
You need to get serious about adding some lower risk.
Greed. I don't like greed.
The thing to be afraid of, honestly, is the thing that we're not thinking of, the black swan event.
There's a tsunami coming. Bye.
Welcome to Retirement Coffee Talk with Charisse Rivers.
Just coffee talk.
There's a lot of noise, a lot of chatter. Who do you listen to? Who do you not listen to? You have to stay focused.
A fun and informative look at the issues of wealth, retirement, and protecting your life savings.
These advisors out there that were trained to sell, and have all these fees. They don't want to talk about this product, so they make less money.
And now, Retirement Coffee Talk with Charisse Rivers.
Welcome once again to Retirement Coffee Talk with Charisse Rivers at Zinnia Wealth. Online, as we always say, ZinniaWealth.com, ZINNIA Wealth.com. If it's time to talk about your retirement, why are you putting that off? Let's sit down and actually put pencil to paper. Do the math on your retirement, as Charisse likes to say. So we'll dive into some of that today. But first, here is Charisse. How are you doing today?
Oh, I'm doing great. I have a nice tan.
Yeah, happy belated birthday, by the way.
Birthday's just a number. I turned another age older, yet I still feel 20 years younger. So that's all I care about.
There you go. Yep.
We went down and did some lobstering in the Keys like we always do. And Ella caught like 15 lobster and Eli caught his first 2.
Nice.
Usually takes you about 5 years when you're a little guy or a little girl from like 7 to 12. Usually 11 or 12 is when you start to see them catch their first lobster. So it was a whole lot of fun. And we went mahi fishing.
Oh, that's a good fish. Mm-hmm.
I know. And and for those people, that's dolphin, not the pretty dolphin, the other pretty dolphin.
Right.
But the captain was like, Charisse, I don't think we should go out. We got to go out 20 miles. There's no dolphin out there right now. I went, we're going. I didn't rent this boat not to go catch mahi. We're going to catch some. And he went, okay. And we did catch some. So I'm glad I stuck to my guns about it. So it was a fun birthday week. And now the kids are off and back to school, and we're just off to the races.
Yeah, I saw your post on Facebook where you were giving us instructions on how to use a tickle stick.
You know what? So many clients and friends always ask, what is lobstering? How do you do it? So when we were out there, I put a demo like, this is what we do. And people started replying like, it's that easy. I'm like, well, it looks that easy. But it is.
How deep a water are you in when you do that? Can't be very deep because you don't have like scuba stuff on. You're snorkeling, right?
Yeah. When you're from the Keys, you somehow, some reason can dive a little bit deeper than most people. Most people want to stay between like the 5 to 7, but we're usually between like the 6 and 12. And so we caught some really big lobster in the 12-foot deep water. And I know people are like, well, that doesn't sound too deep. It is when you're not down there all the time doing it. And Ella was a rock star. She would get down there, stay down there, chase the lobster. I would get down there. I told my son, come after me. I'll tickle it out of the rock, but you come and get it because I can't hold my breath that long because 12 feet is deep. But you definitely, you're just chasing, you're looking for little patches in water and you look for the tentacles, you look for rocks. Their tentacles are usually sticking out and the kids drag behind the boat. In the video, it looks like they're drowning, but they're not. Even mom dragged a whole bunch, but I like to be on alert for the patches in the water and make sure the kids are safe. Yeah. So my job has changed just a little bit, but I caught a few. Good. It's always fun.
All right. Yeah. You're listening to Retirement Coffee Talk with Charisse Rivers at Zinnia Wealth. And online, as always, ZinniaWealth.com. Well, we're going to talk about another sport here today because August is National Golf Month. And if you've been paying attention to the Facebook page, you see that Charisse has lots of pictures of very famous golfers that she's played with. And I'm a golfer. And I wanted to ask you a little bit, my little golf metaphor here today, because, when you stand up to any shot, you kind of size things up. You take a look, is the wind in my face? Is the wind at my back? Are there trees? Are there water? Is there a bunker? Is there something? There's always hazards out there that you're trying to get around. And then you have to choose the right club for the right job. If the wind's in your face, a little bit more club. So that's kind of a metaphor for retirement planning because the winds in your face are taxes and their markets and their inflation and all the different things that we talk about here on the show. So again, choose the right club. So one of your jobs, Charisse, is to choose the right tool for the job. And there's a lot of different jobs in retirement. Tell me how you choose the right club and the right tool for the job.
Yeah. When I play golf, I'm to the point where I know those tools, and I know when I hit my tools wrong and when I pick the wrong one, because you pay for it. You get a really bad score, right?
Right.
And in retirement, it's the same thing. You need the right tools for your income plan. You need the right tools for your investment plan. You need the right tools for your tax plan. You need the right tools for your Medicare plan, and your legacy plan. And really thinking through what tools you need now versus later, I think is key, Randy. Because all these tools, you don't always need them all at once. They're going to come and go through the next 30 years of your life. And the next 30 years, you might be 60. We're not even talking about the Medicare tool till you're 65. The tax tool, I'm talking about it, and our team and our advisors are talking about it every year. But there are times we're not talking about the tax tool because maybe your income's super high. Maybe you sold something. So there's a time to use it and a time not to use it. But just like golf, you can make really big mistakes if you don't have the right tool. And I'm going to be honest with you, I do not know how advisors get away with what they get away with. All the tools we have, from our tax planning software to our income planning software to all the different types of investments we offer besides just a 60-40 portfolio, I'm just not sure how they plan. And I wish the government would actually tighten it up a little bit and like, hey, you got to do this. If you're working with retirees, you got to have this, and that. But they don't, and it never will be that way. And I think that's why a lot of people come to us, because we have a whole lot more tools and we have a whole lot more options. And I got to tell you an example. Somebody just came in a couple of days ago and they were like, okay, so we sat with 4 people and you were referred to us. We decided to drive all the way here to see you. And they were talking about our tools. They're like, wow, we haven't seen this income plan tool before. They're like, wow, this makes a huge difference. We hadn't even jumped into the tax tool. They're like, I can't wait to see your tax tool. So that's the next appointment. But it made it more simple for them to understand their plan. So it wasn't about product selling or this stock or that stock. It's about the goal. And here's the other thing. The conversation is totally different in our office. The husband even said this. He went, well, I've never had that conversation. This is a little morbid. The husband and wife, there was a 15-year difference in age. And she's 47 and he's 60, and he wants to retire in a couple of years. And then he said, hey, I think I'm going to retire a few years later. I'm just going to wait longer. And I said, listen, you both want to retire at the same time. If you decide to wait till like 67 or 70 to retire, there's no telling that you're going to live the next day. I was like, shouldn't you take your go-go years, enjoy your spouse while you both are young before things happen? And he's like, what do you mean? I was like, you're 60. If you retire at 67 and something happens to you at 70, you spent 3 glorious years with your spouse, and then health hits. I mean, that's not the go-go years that you want to spend in retirement. He went, oh, yeah. He's like, you're right. So he's like, I didn't think of it like that. He's like, nobody's really said that to me, Charisse. He's like, you make it sad, but you know what? I see what you're saying, because I'm spending more money, I'm spending more time, and I'm doing it early. He's like, it never dawned on me that at the age of 70 or 75, I wouldn't be able to do the things that I can do at 60 and 65 because it's so far away. And I had to just explain, right around that 73, 75 age, life happens, and all of a sudden you're not doing as much. And he just really appreciated the conversation. So that's a tool that is just my tool, my personal tool, our advisor's tool, just to talk sense into the emotion, the experience, the life that's going to change over the next 10 to 20 years. And so it's not just about money. It's just about life and living with your spouse and experiencing life. Since you guys have worked for the last 34 years, go enjoy it now.
Well, this brings us into that conversation of who is helping you with your retirement planning, because Charisse has brought it up many times. There are people in your life that you may have used like a stockbroker, and she goes a stock jock. And then you get into retirement and you look at somebody at your church who is a insurance person, and they have their place in retirement planning for sure. But what Charisse is saying, having a qualified advisor who has all of these tools, because, according to what their license is according to what they can offer you. And Charisse, being in that retirement space, has all of those tools at her disposal. Give her a call. Let's sit down and have a conversation about your retirement. What she just talked about right there is not a conversation that you're probably going to have with a stockbroker, because she lives in this retirement area. That's where she helps people. Give her a call. It's 833-368-3680. 833-368-3680, or use the website, which is zinniawealth.com, ZINNIA wealth.com. There's a gold box there. It says complimentary retirement consultation. If you click on that, you'll be on your way. All right. So one of the things that we talk about as people come in for a meeting, they're going to kind of bring in their financial life. And sometimes their financial life goes back 10, 20, 30, 40 years. They're going to have some stock that they inherited from mom and dad. They're going to have a couple of 401ks from jobs that they've had over their lives. They're going to have a bond or an annuity or something that they bought years ago with a low interest rate that may not work today. So talk to me about old assets, Charisse. You have to make an evaluation of all of this and say, what is this and can we use it? Is it a matter of usually saying this has got to go and we got to do something new? Or can you give new life to some of those assets?
Yeah. So we have people who inherit IRAs or inherit non-IRAs that have old 401ks, old retirement accounts, stuff that they don't even understand that needs to be changed. But here's the nice thing. They're going to bring their suitcase or box of goodies to us, and we're going to unpack it all and start to look through some things. What I find a lot of times is what a lot of people have, there are things in that investment portfolio that we will still keep. Because why would I sell it, or why would our advisors sell it if they're good? So the only time you really consider making big changes like that, if we're overexposed to one stock, or let's just say you have an old CD and the interest rates are really low. Now it's like refinancing a mortgage. Go get another CD at a higher rate. You might even have an annuity, an old annuity. You know how many old school annuities I have been finding lately that people are making? Oh, a gentleman just came in. He's had it for like 8 or 9 years. He's only making like 1.65%. I'm like, this is insanity. I'm like, we can replace that with a 8.25% rate. I was like, wow, let's make the change. And they're like, wow, well, I didn't know I could because it was locked up. I'm like, it's not locked up. Let me tell you the rules on some of these old annuities. And so we go through that route because they're going to keep them forever. You might as well just get one that has a better interest rate. You might have an old stock. So I had somebody come in with low stock. They had, I don't know, probably $300,000 just in low stock. And I said, okay, what are we going to do with this? Do you want to live off this money? Do you want to do tax loss harvesting and take some of that exposure off and get a little bit more diversified? And he's like, yeah, I would like to get diversified because I don't always think it's the best stock. And so that's going to cost you money because we have to sell some to do it because that wasn't a brokerage account. But let's just say that stock is an IRA or Roth. You can sell all that stuff without any taxes whatsoever. So again, we want to make sure it fits your personality, want it to fit your risk tolerance, because you might come in and just, if I gave you a quiz with 10 questions and I say, hey, could you answer all of these questions? Most people are going to say, I'll probably get 3 out of 10 right. That means that we have a lot of education we need to do. And that means they really don't know what they have. And so we want to educate first, find out their risk tolerance, and then say, hey, let's take this and put this here based on your risk tolerance. Let's keep a little of this, but maybe maneuver a little bit over here. You know, the goal in retirement specifically is not to run out of money, to feel very comfortable and confident while you're in retirement, spending your money, even if the market goes down. That's the key. When the market goes down, how do you still feel good about your advisor? How do you still feel good about your portfolio? And how in the world do you still feel good about buying stuff and going on trips? An income plan. So you got to have that income plan. Without that income plan, you're not going to feel good. You're not going to get it. And you're going to be upside down. And you're probably going to be selling stuff at the bottom because you're emotional and you're thinking, I need my money. And so we really have to think through all these tools and all of these old investments you have to see if we can, make changes now, because right now is a prime window while interest rates are still very reasonable. So those are things to consider. But the older we get, here's the deal. I have people come in who inherit all the stock, but they're super conservative and they're like having a heart attack. All this stock is going down, but I mean, right now it's going up, right? So they're not worried about it now, but they're just like, I don't, this is my family's money that I inherited. I don't want to keep losing it. What can I do with it? And we just have to slowly move it into safe money strategies, right? Not everything has to be in the stock market. Not everything has to be invested, right? Not everything has to be in CDs. Not everything has to be under your mattress, right? And not everything has to be making 30%. You want to be diversified, and a 60-40 portfolio is not diversified. So we want to sprinkle in like 6 or 7 buckets of different types of investments, doing different types of things during different types of market cycles. So people, you're probably thinking, that sounds like a lot to unpack, Charisse. I haven't heard that before because I'm just in a 60-40 portfolio. And yes, I know that. And that's why I'm kind of talking about it a little bit more on radio, because I think it's very valuable.
Well, most everything that you have in your retirement plan should have a purpose. And if something's been sitting around in a box for years and years and you don't know what purpose it has for you, let's give it some purpose. Let's sit down and go through that financial life with you, your past, your present, and your future, and let's take a look at it. You know, I think about when you start having kids in your 20s and you put together a will of some type and it's all about guardianship for your kids. Well, when you get into your 60s, that's not what the deal is anymore. Now it's about something different. That's an example of something that needs probably to be updated. There are other things that probably can have a new purpose in your retirement plan. Let's sit down and talk through your financial life, what it looks like for your retirement, how to make it worthwhile as far as what you're holding on to. 833-368-3680. 833-368-3680. That's a no cost, no obligation appointment with Charisse to sit down and talk about your retirement. 833-368-3680 or ZinniaWealth.com. All right, the guy calls himself the Social Security soothsayer. I imagine a guy with the Johnny Carson Karnak hat on, I guess, and he's giving advice on Social Security. He's just a regular guy. He writes into MarketWatch, he says, I don't get all this angst about Social Security. Take it early. Take it as soon as you can get it, because all I hear is this. You don't know how long you're going to live. The program is in trouble, and everything they talk about making it better means they're going to cut back benefits. So take it now. And so the person who wrote back, the advisor said, well, you're not wrong, but you're also not right. So, Charisse, blanket Social Security advice really doesn't work, does it?
No, it really doesn't. I used to, years ago when I got in this business 20 years ago, give blanket Social Security advice, only because I didn't know and I didn't understand the rules and I didn't understand the strategies behind claiming. I just was like a smart advisor saying, yeah, take it early. Right. And then I learned, but then I learned, and then I implemented an Excel program where I could show clients why it was better. And then I went to the next level and got an IT guy and got software. Makes it a whole lot easier, because every person who comes into my office, all of us advisors here, we want to check it twice, because what we want to do is we really want to just look at the bottom line. How can you really know, unless you're an engineer, what your total assets are going to look like 30 years from the day you start collecting without some sort of income software showing it to you? And you're not. And I don't expect most people to actually have that kind of tool in their toolbox, right? And so what we want to do is we want to check it 4 different ways. What if the husband takes Social Security at 65 and the wife takes it at 62 and they have $1 million? What happens 30 years later on their total assets they have saved by taking it early? Now, then I want to say, okay, what if the husband takes it at 67 and the missus waits to age 67 as well, another 5 years? Then what kind of damper does it put on their total assets later? So I think people, when they're claiming Social Security, they also need to look at how does it affect the total investment? And also, you also have to live long enough. So some of what this guy is saying is right. Like, lots of changes out there. You have to live long enough to make it all work, right? So then what we'll do is, like, what if one of you actually pass away in 10 years and we lose the smaller of the 2 Social Security checks, because that's the rules. That's what happens. then what happens to the asset? Because the surviving spouse is going to have to take a few more dollars. And so then we waiver because then we got to ask the health questions. Is mom and dad still alive? Do they live in their 90s? How is your health? Do you guys feel like you're better off than your parents? And then you got to hope that when you walk out the door, you don't get hit by a Mack truck, right? And so we don't know when we're going to pass away, but we can plan. And then you're going to feel a whole lot better about the plan because we just never know. So if you build a plan based on what we're doing here, then you're going to have a more educated decision. It's just not going to be throwing the dice. Okay, we're going to go here. You're going to feel more confident about the plan. And then you might even have more dollars in your total assets 30 or 40 years later to give to as a legacy and or for the surviving spouse and or to use for long-term care. Who knows? So again, it's strategic. It has to be put ink to paper or Charisse's software. And then you got to make a decision. It's up to you. It's not up to us advisors, but it is the advisor's job to at least show you the path.
Well, there's so much pro and con, so much yin and yang of the Social Security decision. You can say, okay, if I take it early, I get a lower amount. That's not good. If I pass away, I strap my my spouse with a lower amount. That's not good. You know, if I take it at 62, I got to live to my mid 70s to make it worthwhile. Okay. If I take it at 70, got to live to 83. Okay. You can pass on your 401k. You can't pass on your Social Security. I mean, Charisse, we are bombarded with this stuff.
Yes.
But what you have said to me that makes the most sense of everything is your Social Security decision has to fit in with the rest of your retirement plan. And so knowing that there's going to be $2,000 or $3,000 coming in has to go along with what's in your 401k, what all the other assets are, when you're going to retire, when you're going to take Medicare. It's just got to kind of all fit together. So let's forget about all that other stuff. Let's just make it fit into the plan.
Yes, that is the goal.
You're listening to Retirement Coffee Talk with Charisse Rivers at Zinnia Wealth. Online, it is zinniawealth.com, ZINNIA wealth.com. And when you go there, you're going to see a gold box that says Complimentary Retirement Consultation. What is that? That's just a meeting. It's just a meeting to sit down and talk to you about your retirement, what your questions are, what your concerns are. Let's get it all out on the table. And my goal for you is to go into the meeting and know a whole lot more about your retirement than when you went in. And I can really think that that's going to be the case when you sit down with Charisse. Again, the number 833-368-3680. All right, so we all know that we want to put away money to spend in retirement. Interesting study that came out that says where you put that money will determine how you spend that money. What do I mean by that? Okay, retirees with guaranteed income, things like pensions and annuities and checks that come in. Social Security would be another one. If you have money coming in like that, a retiree will spend 80 cents of every dollar. But if you decide that you're going to just take that big 401k and you're just going to peel money off the top of it, retirees average about 50 cents of every dollar. They don't feel as secure spending that money. Retirees look at income like Social Security and annuities and that kind of money as spendable money. They look at their investments as wealth preservation. It's really kind of interesting. So, Charisse, that means for you, you got to move money to that place where they're going to spend it. Otherwise, they're not going to enjoy it. So is that kind of difficult? You say, here's your big 401k. Let's move it into this in order for you to spend it.
Gosh, it's psychological, it's emotional, and you are spot on, Randy. It could not be more spot on. It does not matter who I'm talking to, who comes in. If it is not an income annuity and annuity, if it's not Social Security, it's not a pension, they don't spend it as much. So I'm really pushing the envelope with clients. I literally sat with 4 clients doing a review. It was a few weeks ago in the Gainesville office. And all 4 of them, we really front loaded their incomes. Their incomes were between $200,000 and $300,000. And for 6 years, I've been saying, we provided this plan. Now I need you to spend the money because they're not spending it all. And 6 years later, they went, you know what, Charisse? It sounded great, but you really did a good job with income and with our investments. And we just have a hard time spending it because we have no debt and we are going on trips and we are flying first class. So we had to literally, all four of them, they were like identical. I had to change their entire plan that day, each one of them, because I realized, okay, if they're not going to spend more, then we don't have to have that income plan as conservative. So let's now flip-flop and take that income plan and change and drift over to a little bit of a growth strategy. So what they did is they saved in fees. They're going to have a higher rate of return. And now they're not going to feel like they have to take as much money, but they were taking money from that income plan. So now that life has changed a little bit, they're all a little bit older. They're just not doing as much. So now we shift gears again. And it's interesting. It's the first time I've seen this gear shift. So I go through every 5 to 10 years. I see changes in everyone's lives. And this was a big one for me. And it's nice that we front load income during our go-go years. But it is hard for people to spend. And I'm like, go give it to your grandkids, go donate it, go do something with it. And it all sounds good. But people have a hard time pulling that money out of their pocket to do those things. So without me, you're going to spend less. Okay. With me, we're going to help you and teach you and make you feel confident to spend more and then watch your assets grow at the same time. But I will say that it is hard. You have this 401k. Most people don't have pensions anymore. So you retire and you are your own pension manager. And hear me out. Income makes the world go round. And you all know that. You've gotten a paycheck every 2 weeks, your entire lives. And as long as you got that paycheck, you knew exactly what trip you can go on. You knew exactly what car you can buy. You knew if you had to clip coupons or not, right? And so now you retire. A lot of you are out of debt. You have this big 401k, this mound of money, and now you have to figure out how to be your own pension manager. And because of that, you naturally, by default, will spend less. I guarantee it 9 out of 10 times. Now, if you go to a stock doc, life isn't going to change over there. You're not going to spend more. If you come to Zinnia Wealth Management, we're going to show you how you can spend more with some mathematical equations, with some income software. And every year, that is a living, breathing instrument. And if you don't spend your money, we're going to say, okay, so this one back into your portfolio, but do you think we can spend the money this year? And so we keep having those. I know they sound like elementary conversations, but people are like, yeah, you're right. I can. And so it's a fun conversation to have as a financial advisor. A lot of financial advisors have very stressful jobs. I really don't feel like I'm stressed out. It's probably why I'm always so happy. And I just love what we do here at Zinnia because it's like giving flowers to people, right? That's the best job in the entire world, I would assume. But we're giving income to people. Like that is another really great job. Even when the market goes down, I don't stress out because our clients know the plan. They know they're not pulling their income from those buckets or pulling it from the other buckets that didn't go down. And that gives people peace of mind, in my opinion.
One of the things about us is in our working years is, Charisse says it very well. When your bucket is filled up every 2 weeks, you go and you spend it. In retirement, if your bucket is filled up every month, you feel good about spending that money because the bucket's going to get filled up next month. But that 401k, unless it's growing in the market, it doesn't look like it's getting filled up every month, and you keep taking the balance down. That freaks people out. Let's get your money in those places where you feel confident to spend them. Give Charisse a call, and let's explore those options. It's 833-368-3680. 833-368-3680. It's a no-cost, no-obligation meeting. Let's just get your questions out on the table. Let's get your concerns out there, and let's handle them right on. It is 833-368-3680 or ZinniaWealth.com. Well, we haven't talked about the stock market at all, Charisse, here, and I have kind of an interesting little sound clip that I want to play for you. The market, and you and I have talked about this over the last couple of years, it has been held up by what they refer to as the Mag 7. All these tech stocks that have pushed up, them all, Google and Microsoft and Apple and Tesla and all these different things. And it's been held up. But now the Mag 7 is starting to fade a little bit. It's not driving the market like it used to, but the good news is the rest of the market is starting to come up. This is Stephen Parker on CNBC talking about the broadening of the market.
The conversation that we were having back in December was this is all about the Mag 7 and the hyperscalers. And then look what's happened this year. The Mag 7 is down and the market continues to move higher. Well, it's all about the tech sector. And then we saw disruption in the software space. And now we're seeing a big pullback in semiconductors. And yet through all of that, that the market is near all-time highs because we are seeing a broadening. Earnings are continuing to deliver. A lot of that is tech, but you look at industrials, utilities, financials. This is a broader story, and that I think is really healthy.
Yeah, so let's talk about that, Charisse. Does this give you some confidence that this particular market has more room to run? Or does it give you still some concern about we still have to have our protections in place and be, very cautious as we move forward? Well, how do you read this one?
So the market is broadening now. And I am even more bull on the market than I had been for years. And I always use the term, the world is your oyster. And when we see changes in the Mag 7, or we see changes in the stock market or the economy, we see some things coming up to the front, maybe in the next 12 to 24 months, we as a firm also make changes. And so the broadening is the sectors are changing, right?
Okay.
So it's not always just tech. It's not always just the Amazons. It's not just always the Walmarts. So in sectors there's 11 sectors: industrials, consumer staples, technology, real estate, finance, you name them. And so this is why I love what we do here. Sector rotation is one of our portfolios. And I absolutely love sector rotation because you can have a bunch of indexes and funds in these different sectors. But if you're picking the top 3 sectors because the market is broadening and maybe some of these other things aren't doing so well, and this is an actively traded account, then there's likely, I always have to say likely because it's stock market, it's never guaranteed, a chance that there could be less volatility and more money being made in that type of portfolio. But we still have people in our tech portfolio. We still have people in our exit strategy, day trading, ETF portfolio. But we sprinkle these dollars a little bit more heavy into the sector rotation portfolio right now because we feel like sectors are, in my opinion, are a little bit easier to measure, and the sectors are changing and we can follow these sectors. So because of all these sector movements, it's making the market broaden. It's making a nice market growth, even though there's other things coming down like the Mag 7. So you want to be diversified. You want an advisor that are keeping their eyes out on things like this, that are making these changes. Because if you're doing what you were doing 2 years ago, you're probably just not making as much money, right? And so you have to think about those things if you're in the stock market. Now, that's the risky side of what we do. There's also the safe money side of what we do, but that is also important in a portfolio.
Well, one of the things that Charisse has talked about a lot over the years is this economic cycle. We have this upturn, and then there's kind of a plateau, and then it goes down, and then it comes back up again. It's kind of this cycle of things. And those sectors that she talks about are in each one of these cycles are the ones that you want to be in. And, those of us who have lived our lives and our careers in something different over the last 30, 40 years, that's not something that we've been in every day. It is something.
And they change quick.
You do.
And they change really quick, Randy. So you got to be really on it. And sometimes it's hard to catch, right?
And that's, you live in it every single day. And that's why I think it's really important to have someone like Charisse on your side, to sit down with Charisse and talk through some of these things. And that market is, up and down and sideways. And, to think that my retirement would be dependent on a market that goes up, I'm uncomfortable with that. Let's see how comfortable you are working in that stock market. How much of it do you want in there? And let's find that happy place for you. Here's the number, 833-368-3680, 833-368-3680, to sit down and talk to Charisse about your thoughts about retirement. Bring to the table what you have done all your life. You have saved well. Now, what does it mean for you as a paycheck in retirement? What are you up against? Let's get it all out on the table. 833-368-3680 or ZinniaWealth.com, ZINNIA Wealth.com. Click on that gold box. You'll be on your way. All right. All that boomer money is coming down to their kids, and it's causing a myriad of problems. Here's the story. Dad decided to retire in Florida, and he moved into a 55-plus community. Everything was going along fine until he got sick, and his 28-year-old daughter moved in with him to take care of him. He passed away, and he gave her the house. That's a problem because she's 28 years old and it's a 55-plus community. The HOA mounts a legal effort to kick her out. She's too young. And they assessed everybody in the community $1,000 to spend $150,000 on lawyers to kick her out. And they actually even assessed her the $1,000. She was actually contributing to an account that was going to build the case against her. Anyway, so
tough crew.
I know. So anyway, at the end of it all, she's like going, look, I'm 28 years old. I got this gift from my dad. It's really hard for us right now to buy a house. Come on. And so I'm thinking, rules are rules, Charisse. I get that.
Of course.
I wonder if there's anything Dad could have done to try to smooth this over, make it easier on her. What would you say about this? I mean, we're getting into the legal area here, but it really is when you inherit a house, you inherit something. It is not always smooth as silk, is it?
You know, it's interesting. It didn't even dawn on me. You know, retirees having homes in the 55 plus age category, and then these kids inheriting them at younger ages and yet not yet being 55. And so you just taught me something really quickly here, Randy, because it's never been an issue in my office. But yeah, what if the stock market was crashing and the real estate market was just down, and now she has a forced hand to sell this house at maybe half the price?
Gosh.
So there really does have to be some serious thinking when it comes to that legacy plan based on the age of who's inheriting this. Like literally, I'm a little thrown off here because that's really important. Of all the things I know and I've been through attorneys and our clients and probate, that one is really important. So the question is, she could keep the house. She would just have to rent it out, and she would have to just suck it up and go. If she can't buy a house right now, she have to go rent, right? Until maybe the market came up, if that was the case, or until it could sell, till interest rates were just right. So yeah, the person inheriting the money, it is a headache for them. But you know, there definitely has to be some serious planning involved, and maybe the trust. Instead of just letting the kids inherit the house, they can inherit the house, but to say in the trust, this house needs to be sold, because if you are not 55 and above, then it must be sold. So the dad needed to know what the rules are, but most people don't even think in that manner. And like I do this for a living, and I was like, oh yeah, that is a problem, isn't it?
So one of the things I thought about here was that you and I talk about having the documents in place for legacy planning, a will, a trust, a directive, a health directive, power of attorney, all that kind of stuff. And that's important to have all that in writing. But at the same time, I think it's important for everybody to have these conversations while they're all alive. And, you know, for Dad to say, I got everything in place, that's one thing. But to say, I've got everything in place, but here's what you're going to be up against, and we have to plan for this. For him to say, you know, the best thing for you to do is for me to put this in the will that you sell the house, and then you go get your own house someplace else or something like that. But having these conversations with your kids, this kind of shows that estate planning is not just putting together a document, correct?
Yeah. Yes. At a certain age, I truly believe not too early do you discuss all your assets with your kiddos. But when they're mature enough, and when you're at a certain age, you feel comfortable letting them know what you have, because you might need help from them. You know, you have to have those conversations. There's too many people out there. I mean, I have clients today. They's like, Charisse, I just don't want to have the conversation with them. I don't want them to know I have this much money. I'm like, okay, but if something happened to you tomorrow, what would they do? Like if something happened to both of you, husband and wife, what would they do? Would they honor your wishes? Would they do the things that you asked them to do with the money? Would they go spend it and buy the Ferrari you never did? So, you know, having those conversations at a certain time, and sometimes you don't have to spell it out and say how much I have. Say, hey, you guys are going to inherit some money, and this is what I'd like you to do with it. And I want you to use it for retirement, right? And, you know, just have those conversations. And you can say all you want, and the kids still do something different. But a lot of kids will listen to their parents, especially as they're getting older, and they'll respect that after you've passed. That is one thing I have noticed. But the people who don't have those conversations, that just trust their kids because they're so smart, they're the ones who will buy that red Ferrari. I've had it happen. They're the ones that are going to go buy all this stuff and not save it for retirement. I've seen it too many times. The people who do have conversations with their kiddos at a certain age and disclose some stuff, it happens differently. That's all I can tell you that I know, is that it's smoother. They understand it. They preserve their money because there's been a heart to heart. And so those conversations to me are very important. I will have those conversations with my kids when they get older. I already have those conversations with my kids because you know what? If something happened to me tomorrow, they're young. I'm already telling, hey, if something happens to me, this is what happens with the monies. They don't know what I have. They don't know nothing. But I just said, but I need you guys to be good savers. And this money is for you guys in the future when you retire, you know, those types of things, and for college. And they're just like, Mom, why are you having this conversation with me? I'm like, you'll thank me one day. Trust me.
Yeah. It's important to have the documents in place. It's also important to have an open conversation. I always remember the time when my mom went into memory care, and there's somebody that you go see, and she's basically a salesperson who's going to show you around and that kind of thing. And she had just this ashen look on her face. And it was just, I go, what's going on? She says, I've got a family upstairs with 9 kids. And they're considering bringing Mom here, and only half of them agree. And so they're just upstairs just going at it, and it's just like, oh, how awful.
Yeah.
And that's what happens in these situations, unless not only do you have the documents in place, but you're also having a conversation with your family, telling them what your needs and your wants are.
And don't forget, like a lot of us, people my age, we're in the sandwich generation where some of your parents didn't save enough money. They're going through long-term care. They're actually moving into your house. You're taking care of them until they pass away. Like that's a big thing happening right now. And those parents out there, like if something starts to happen with your memory and you're going to need help with your kids, you better get on it right away and talk to them, because there are specialized trusts and specialized things that you can do for preservation of assets, especially if they're going to take care of you, if they're going to take time off of their job, if they're going to pay for things and I put you in another room or in their house or do these extra things. Like those conversations are just incredibly important earlier than later.
It's all a part of the retirement planning process. It's one of those things that you really do have to talk through. And to sit down with Charisse and talk through your wishes about that and maybe get some advice of how to break that to your family and how that's all going to work, give her a call. It's 833-368-3680 or zinniawealth.com. Well, there's a fun article in the Wall Street Journal that says one of the new status symbols out there is an immaculate lawn. People are really getting into it now. I want my front yard to look like a golf course. And so, and it was interesting about it. And it said that there are 3 stages of lawn mowing in your life. First, you mow your own lawn. Then you pay somebody else to mow your lawn because you don't want to do it anymore. And then at the end, you kind of go, you know what? I kind of enjoy this. I'm going to go out and do it myself. So we relate everything here to retirement planning. And Charisse, there comes a time, and you have told me this, that your whole life, you've been working with your investments, you've been following it, you've been doing it, and then you go to a financial advisor in retirement and you say, I still want to have my hand in this, and you do, and Charisse says, that's fine, you can manage this little portion over here, whatever you want to do. Charisse, when do you get to a point? When do you see people go, Charisse, I don't want to do this anymore? Can you just handle this?
Everything in retirement is about time. Everything before retirement is about time. It's with the time left on your watch. So yeah, you start your careers, you mow your own lawn, then you're like, okay, I don't have enough time. And they're saying I'm supposed to pay somebody to do it. So I have more time to do something else. And you pay somebody, and then you get into retirement. And all of a sudden you get more time, and now you are doing your own lawns and you're making them pretty. Beautification, right? That's the thing right now. And so in retirement, we don't have as much time on our watch, but we have all the time in the day to do all the things we've never been able to do. And it always starts out with the honey-do list when you first retire. That usually takes 3 to 8 months to get through. And after that, you're like, okay, now let's start booking our trips. And now you're booking some trips for a few years, and you're like, okay, we got 25 years still left in retirement. Let's have some hobbies. Maybe we'll pick up banjo or piano. And then you do that for a few years and like, okay, now I'm bored of this. And so I watch these phases of life that people go through. It's quite fun, but it's all about time and how much time is left on your watch, how much money have you saved. It's all psychological. And I always let people know that be watchful of your time, because time is not guaranteed, right? And so if you have the health and you have the will and the want, get out there and do your lawns, because you can now. And I just think it's incredibly important. And the other incredible thing about retirement is that you have money. A lot of people have money saved. So what are you doing with that money? What kind of time are you putting into spending that money, whether it's taking your grandkids to Disney. I have clients that take their grandkids to Europe. That these parents don't take their kids anywhere. It's all about the grandkids, right? And teaching them things and experiencing life because, moms, dads, how many summers do you have left with your kids? Make sure every moment counts. But grandparents, it's the same thing. Your grandkids are going to grow fast. Like, how many summers left do those grandkids have till they graduate high school? Because once they graduate high school, you're just not going to see them as much. So take that time, take that energy, take those bucks and go spend it on the things that you love most. And that's family time, that's experiences. And if you're somebody who doesn't travel, then it's the lawn.
Yeah, exactly right. I said the other day, I think I made a bumper sticker, Charisse. I said, you spend all these years putting money in the bank. Now it's time to put memories in the bank. So let's sit down. And what Charisse is talking about there is having your priorities in the right place and not having to worry about investments and money and taxes and all that business that's out there. Let Charisse worry about that. Let's sit down and build you a plan that you can say, okay, I can go out there and enjoy myself with some confidence and put my priorities in the right place. Give Charisse a call and let's build that kind of a plan for you. 833-368-3680, 833-368-3680, or use the website ZinniaWealth.com, ZINNIA Wealth.com. It's a no cost, no obligation meeting to sit down and talk through your retirement concerns. Charisse, that is all the time we have for today. I'll give you the last word on this one.
If you want to spend more in retirement, pay less potentially in taxes, and be more diversified, you're going to want to hear this show. So as usual, live by design and not by default, and we'll see you here next week.
This has been Retirement Coffee Talk. To find out more about how the strategies we've discussed on this program can build the retirement you've been wanting, call Zinnia Wealth at 352-368-3680 or visit us online at ZinniaWealth.com.
Investment advisory services offered through Zinnia Wealth Advisory, LLC, a registered investment advisor. The firm only conducts business in states where it is properly registered or is excluded from registration requirements. Registration is not an endorsement of the firm by securities regulators and does not mean the advisor has achieved a specific level of skill or ability. Insurance products are offered through Zinnia Wealth Management, LLC, Florida license L078655, and Charisse Rivers, Florida license P037744. Zinnia Wealth Advisory, LLC, and Zinnia Wealth Management, LLC are affiliated entities. The information presented is believed to be current. It should not be viewed as personalized investment advice. All expressions of opinion reflect the judgment of the presenter on the date of the podcast and are subject to change. The information presented is not an offer to buy or sell or a solicitation of any offer to buy or sell any of the securities discussed. You should consult with a professional advisor before implementing any of the strategies discussed. Any legal or tax information provided in this podcast is general in nature. Always consult an attorney or tax professional regarding your specific legal or tax situation. Any client experience discussed on this show are unique to that client. Annuity and life insurance guarantees are subject to the claims paying ability of the issuing insurance company. If you withdraw money from or surrender your contract within a certain time after investing, the insurance company may assess a surrender charge. Withdrawals may be subject to tax penalties and income taxes. Persons selling annuities or other insurance products receive compensation for these transactions. These commissions are separate and distinct from fees charged for advisory services. Insurance products also contain additional fees and expenses. Social Security rules and regulations are subject to change at any time. Always consult with your local Social Security office before acting upon any information provided herein. References to specific investments should not be construed as being past specific recommendations. The returns for various indices discussed in this podcast do not represent the performance of the firm or any of its advisory clients. Returns do not reflect the impact that advisory fees will have on an investment. Past performance may not be indicative of future results. All investment strategies have potential for profit or loss. Different types of investments involve higher and lower levels of risk. There is no guarantee that a specific investment strategy will be suitable or profitable for an investor's portfolio. Historical performance returns for investment indexes and or categories usually do not deduct transaction and or custodial charges or advisory fees, which would decrease historical performance results. There are no guarantees that a portfolio will match or outperform a specific benchmark. Investments in fixed income products are subject to liquidity risk, market risk, index rate risk, credit risk, inflation risk, purchasing power risk, and taxation risk. Because bond prices fluctuate continually, their yields change constantly.